Hello, everyone. I'm Catherine Murray, and welcome to my program, The Buck Stops Here, where we discuss and dissect the matters that impact Canadian businesses, both large and small, the markets, and your money. My goal is to bring you the most sought-after thinkers, investors, and strategists, really in order to provide you the best insights upon which to make some of your decisions in life. With that said, I am thrilled to introduce Gary Shilling, famed investor and very, very well known for calling the bond bull market in the late 70s the best returning asset class for the past number of decades. He is president of Gary Shilling. Gary, great to be able to catch up with you and get your insights. There's just so much to discuss. You do have a report, 30 pages or so. So there's a lot in there. We're going to try to get to quite a bit of it. But thank you again for joining us.
Always like to be with you, Catherine.
Thank you. I wanted to really ask you, with so many different aspects going on in the world, whether it's China, the Fed, inflation fears, commodity prices spiking, labor shortages, really as we sit back, what's the most important factor to be thinking about as to how it's really going to impact all of our lives?
Probably it's the Federal Reserve right now, monetary policy, because they're in a situation now where they are really considering whether they ought to tighten credit, whether they ought to cut back on their purchases of mortgage-backed securities and treasuries, and then begin to raise interest rates. And of course, this is a very difficult situation now because the economy is not exactly rip-roaring as many people thought, and we've got the Delta strain of the virus, which is unknown. So it makes it a very difficult situation for the Fed, and consequently, everybody's trying to outguess the Fed, and I think the Fed is trying to outguess itself.
And so I hear you in terms of the Fed outguessing itself. That could have some significant implications. I mean, we talk for so many years. We've talked so many years about the Fed historically making policy mistakes. I mean, is that what you're leaning towards? Do you think they might make a mistake here?
Well, you know, they're not infallible. They're human beings, and but the risk is unusually great right now because there has been so much emphasis in security markets, really going back to 2008, on the largesse of the Fed and the other major central banks, the Bank of Canada, the Bank of England, Bank of Japan, the European Central Bank, and so on. They've really been fueling the stock market boom that started in reaction to the financial crisis in 2008. And I think to a great extent right now, there's so much dependence on this. You look at the height of stocks, particularly in this country, very, very overblown by any historic standards, and it doesn't leave much room for error. Now, having said that, I want to point out as well, the Fed has basically become an arm of the federal government. It's supposed to be independent, but they are really, I think, taking their clue, and they're deadly afraid of upsetting the apple cart. You know, they talked about years ago about the Greenspan put, the idea that Wall Street could put bad news to the Fed would bail them out, and then it was the Bernanke put, and then the Yellen put, and now the Powell put, the succeeding chairman of the Fed. So the Fed has got a lot of heat on it for carrying the ball and having created a situation where they don't have an awful lot of options.
And so they don't have a lot of options, but at the same time, we've seen this repeatedly over the past number of years that we always think they're going to raise rates or really significantly pull back the bond buying program. And they're almost in this position where they don't seem to be able to do that because of the dependence on lower for longer stimulus to keep these asset prices high. Governments can't afford a higher interest rate upon which to pay their interest payments. So how do you think this might play out?
Well, you know, sooner or later, something's going to happen. Now, it could be right now that high oil prices upset the apple cart. They are draining away purchasing power. Is that enough to really touch off a downward spiral in stocks and economies around the world? I'm not sure. I don't think so, but it's a possibility. But something's got to give here. You know, as they say, trees don't grow to the sky, and you can't expect stocks or anything else to rise forever, because as stocks rise, the confidence in their rising increases to the point that it gets overblown, and that's a typical speculative bubble. So I think that sooner or later there's going to be problems.
And we are back with Gary Shilling. Gary, you know, when we're talking about the Fed and perhaps making a bit of a mistake, we also want to, of course, wrap what's going on in the economy into the equation, because presumably they can raise rates if the economy is strong. But you seem to be suggesting that the economy is, in fact, not strong. Can you go through specifically what you're looking at to come to that conclusion?
Yes, if you look at retail sales, you look at total consumer spending, you don't see the huge burst of spending that many people anticipated. They thought that all the stimulus that was given to consumers by the federal government, the bailout, what happened that started last year, and you've had 3 rounds of it, but people are saving most of that money, and everybody thought, okay, they're going to saving it. I mean, the first round they saved 75%, the second round 76%, and the third round 79%. And the expectation was they were going to go out and spend that like drunken sailors. Well, that hasn't happened. I think people were really scared by the pandemic, and so they're rebuilding their assets. In the meanwhile, we've had this burst of inflation. It means that real incomes, in other words, incomes adjusted for inflation, are actually declining. So you have people interested more in saving, in caution, than in spending, and their incomes are not spurting ahead in real terms, certainly. So I think there are limitations there. And if you look at other measures, employment is growing. A lot of people are staying home. They've dropped out of the labor force. You know, this pandemic has had some very far-reaching effects. We won't know for sure for years, and you never know what looks important today is going to prove to be important in the long run. But I think one of the things are people are really rethinking their lifestyles, where they want to live, how hard they want to work, whether they want to spend more time with their families, and so on. And I think it means, on balance, that you just don't see a burst of economic growth, and it certainly isn't there in the statistics.
So I'm quite confused, actually, with respect to the labor market. I mean, it was a very disappointing jobs number last week in the United States. There are labor shortages, but there's a lot of jobs available, apparently. People talk about a skills mismatch. I'm not clear in terms of how to actually read what's going on in the labor market. Because I think you also bring up the fact that there's probably companies who, you know, are going to be a little bit hesitant to hire again, just given the additional costs. Why not just have part-time workers, which is maybe why we're in this position to be, you know, to begin with, because people don't feel as loyal to companies and corporations. But what's the right read on the labor market?
Well, if you believe in free markets, you don't have a surplus of jobs or a surplus of workers. Prices adjust, wages adjust, and things iron out. But right now, there are a lot of job openings. Now, how real are those openings? I think a lot of them are yes, we'd like to have people there, but after having laid people out in the pandemic, they want to make sure they get exactly the right skills. So the employers are being a lot choosier in who they hire. And again, employees, so there are a lot of job openings, but how many of them are real? How many of them are there where they'll take almost anything and walk through the door? I think much less than the overall number suggests. And in the meanwhile, again, you have a lot of people who basically say, "Well, I'm gonna stay home." Now, one of the things that has happened in this country, we had supplemental unemployment benefits, $300 per week U.S. On top of the usual unemployment benefits, and that meant that 42% of employees in this country were better off at home than they were working. And that didn't count their cost of commuting or business clothes or childcare or so on. So a lot of people really, unless they had fire in the belly for work, they were gonna stay home. It was a pretty good deal.
Yeah.
Now that's over now, and I think we're going to see a lot more people uh, enter the labor force and take jobs because they no longer have that government support.
Right, and we've experienced that in Canada as well. I'm wondering though, and we'll pick it up in the next segment, but with that said, with people perhaps having to go back to work, getting that fire back in their belly, will that not lend itself to the reopening trade, which has had fits and starts, and therefore perhaps better growth than I think what you're suggesting? But let me leave it on that note. We'll take a quick break and we'll come right back. And we are back with Gary Shilling. Gary, I do want to pick it up on the question that I have as to whether or not the reopening, because we're really nowhere there yet, really, will lend itself to perhaps an elongated business cycle and a very good economic growth picture. You don't see that, though, do you?
Oh, I don't see anything in the immediate future that's going to cause a halt to this. And as you know, Catherine, I've had pretty good success over the years in seeing imbalances and calling recessions. Well, I don't see anything in immediate right now. As I say, you can always conjure up some problem. Again, spike in oil prices or a big mistake by the Fed, but there's nothing sitting out there like the excesses in subprime mortgages in the mid 2000s or the dot-com bubble in the late 90s. There's nothing like that just itching to collapse. So no reason this thing isn't going to continue. I think the real question is it's what is likely to happen versus expectations. Now I think people are cranking down their expectations. The International Monetary Fund, as you probably know, just came out with numbers, and they reduced their growth rate numbers on a world basis, and particularly in developed countries. And this is not unusual. You find a lot of these bodies are cranking down their numbers, and they're getting more realistic. That doesn't mean they're seeing the end of the world, but they're just not wildly enthusiastic. I think people thought that this pandemic was a kind of thing and it's over. And we Americans, we like projects. We like a project. You enter it, you solve it, and then you march on. And COVID was one of those. Well, the vaccines, they didn't quite work as well, and people wanted to stay home, and it didn't sort of all go away, and we're back to a roaring economy. It's much more of a gradual reentry. So I think it's more accommodation to reality than it is any bleak reality out there. That's the key to what's going on.
Interesting. So no excesses that would cause concern. But let me just ask about what's going on in China and the Evergrande properties and whether or not there's more Evergrandes behind the scenes. That's what most people would say or suggest. But does that not play out in terms of the economic global outlook, in terms of a downdraft?
Sure it does. Now, in portfolios we manage, we're short copper because copper is big in construction, and when you see the clamp down on the property market in China, and this is a president for life, Xi basically is president for life, and he just doesn't like to see the private sector get carried away. Doesn't like speculation. They're moving more and more toward government control, and that means you're going to have slower growth. But for the same token, China doesn't stand by and watch the economy collapse. If things really get dicey, you'll see the usual spur of infrastructure projects, build more ghost cities they don't need anyway, but they always manage to keep people employed. So there's a rough spot, and it does have implications for the rest of the world, particularly commodity markets. But I think we're going to see slower growth in China, but I don't think it's going to lead to a worldwide collapse.
And just while we're on the topic of China, what concerns you, though, about China and Taiwan and U.S. policy surrounding that?
Boy, that's a tough one, and obviously Biden is being tested on this. Taiwan and China are, as usual, at each other's throats, and it really, I think, is ultimately a question of what is the U.S. position going to be. Now, we're trying to ride both horses. We certainly have strong economic ties with Taiwan. We also have relations with Canada. With China. You can't avoid that. They're the world's second largest economy. But I think that I think there could be some clashes there because China is expanding. They had this Belt and Road policy where they were providing all kinds of infrastructure to other countries, saddling with big debts. That has not worked out to their satisfaction. They're building all these islands on reefs in the South China Sea, flexing their military muscles. And Taiwan, of course, is a thorn in their side. So I think there could be further frictions there. Is this going to result in all-out war? Very unlikely.
Okay, Gary, it's interesting to hear you talk about shorting copper, especially at a time where I'm hearing more and more strategists and investors on the street saying go long copper. So, but I hear you. We're going to take a quick break. When we come back, we'll get a little bit more in terms of your investment themes and where you're long and where you're short. We'll take a quick break. We'll be right back. Gary, with your view of the world and, moving pieces and parts, no recession coming in the intermediate term, valuations are high in the equity markets. I want to remind our viewers that you did call the bond bull market decades ago, and that has been the best performing asset class. So with all of that said, what do you think are the opportunities right now? And how obvious are they? I don't think there's too much that's obvious.
Well, I think they're limited, really. Stocks are extremely fully priced. Again, I think some commodities, copper in particular, could be weak, but other commodities, oil, iron ore, are moving in the opposite direction. It isn't the general route in commodities. It's much more specific. Treasury bonds, you're mentioning, Catherine. My 40-year favorite. Mm-hmm. Right now, they've been basically moving sideways in the last year or so. If the economy weakens and this inflation scare goes away, I think we could see further increase in Treasury bond prices here. But it isn't like we were back in the early '80s when the yield on the 30-year Treasury was 14.6%. It's now 2%. Mm-hmm. It's been a tremendous rally, so you don't have that ahead of you. I think in portfolios we manage, we've got heavier cash positions than normal, just to indicate a degree of caution and lack of feeling that there are great investment opportunities out there.
Where do you see the U.S. 10-year yield moving ultimately?
I don't see any wild fluctuations there. One way or the other, the dollar has been strengthening a bit lately, but not running away. And Canada is to a great extent, or at least some extent, driven by commodities. But I don't see anything to suggest there are any big movements in the loonie versus the greenback.
Mm-hmm. And with respect to just going back to oil, because we've seen such a huge run, now some of the investment firms are seeing the bull case as well over $100. Where do you see oil ultimately settling out?
I think oil is probably getting close to a peak. A couple of reasons for that. One is American frackers, they're in and out. They can drill these wells very quickly and then turn them off very quickly. And when prices get up, when you get $80 a barrel, hey, it's very attractive for them to drill, and they do so, and they produce a lot of oil very quickly. On the other side of the coin, OPEC years ago learned that high prices are not to their benefit because it encourages conservation, it encourages substitution, and as a result, they've learned that being greedy is not the best long-term policy. And of course, you also have this tremendous push for alternative energy, for green energy. I think that's going to be one of the most interesting things developing, because people are all for green energy, but boy, when it costs them, $3.50 a U.S. gallon to fill their tank, they feel a little differently. And when you get down to a pocketbook issue, I think a lot of the great hopes for green energy and carbon-free atmosphere disappear. So I rather suspect that we're going to see more petroleum production. That it's not going to be closed down as quickly as many of the green advocates believe. That has just happened so dramatically and so fast. And I just don't think it's sustainable, at least not at this rate.
Right, we weren't quite prepared for the variable energy sources. Gary, just quickly here as well, with respect to the equity markets, high valuations for sure. You have a higher than normal cash position, but what does one do with the equity markets?
Well, say I think you have to proceed cautiously. I mean, we're long equities. We're top down. We don't really get involved with individual equities, but portfolios we manage. We're long the S&P as a broad index, and I think there's no reason to think it's going to collapse immediately. We're long treasuries. We're short copper. We're long the dollar. I mean, that's pretty much our investment philosophy right now.
Okay. Gary, we have to leave it there. It's always great to get your perspectives. Thank you so much.
Glad to be with you as usual, Catherine.
Thank you. We'll speak to you soon.